With more than 41,000 companies listed around the world, the task of finding good businesses can be overwhelming. Where should you look to find good businesses? Is it enough to look at the stock price and hope that it just goes up? Well, in this video, I'm going to describe my 5 steps to find and analyze good businesses. So without further ado, let's dive into it. So the first step is to obviously find stocks, find businesses, right? I like to talk about businesses more than stocks because stock is just a representation, it's a price that we give to the business, but what we want to find is good businesses. So the first thing that we need to do is to use a screener, something like Tikr or simply Wall Street to find good businesses by a different criteria. So you have the links to my reviews for Tikr and simply Wall Street in the details. And another nice source of valuable stocks or valuable information are superinvestors. So I have a list of superinvestors, like for example, Warren Buffett and Bill Ackman and Charlie Munger and other superinvestors that I use in my research, and you can find the list in the details below. And you can go to a website like Dataroma, for example, to analyze their buys, as they need to be reported to the SEC in the US. So this is a very good source of information. I'm more interested in the buys, obviously. Again, as I mentioned in my previous video about on Simply Wall Street, is what they sell is not too representative because they can sell, investors can sell for multiple reasons, but we know that they buy when they think something is going to go up. So yeah, go to Tikr or Simply Wall Street or another search screener that you like and use your criteria. So the next thing that you want to do once you have identified one or multiple companies that you're interested on, you need to find out more about the business. So this is something that is one of the most important steps, understanding what they do and understanding different, the financials, and understanding more about the companies. It can be boring because what I recommend is that you go to their annual or quarterly reports. This is important. These are called the 10K and the 10Q respectively, and these are the reports that are necessary to send and report to the SEC in the US. So this is a very important step. Those sections those documents can be a bit overwhelming because there is a lot of information. There is quite a lot of boilerplate code, but what I would recommend is that you look into specific sections. The ones I look into are, first of all, the business section, which is all the documents have the same format, by the way. So there is a business section, which is where the company explains what they do, the industry where they operate, and the products that they create or they build. You look as well at the risk factors, and this is very important. You need to look at, there's 2 types of documents here. There's the documents that they create, the presentations that they create for investors, and then there is the actual 10K and 10Q reports. So you need to look into the 10K and 10Q reports. These are the hard cold data that they report to the SEC, and the risk factors. The companies are quite honest there, and they summarize a lot of factors, a lot of risk factors. They talk about competition, they talk about the economy, they talk about anything they think that could be driving the stock or could be driving the business in a certain way. Obviously, you need to take a look at also the financial statements and also the management discussion. That's really important and very, very interesting as well. So all these 4 sections, the business section, the risk factors, the financial statements, and the management discussion are the ones that I look into when I go to 10K and 10Q reports. Also look at what drives the stock. Right? We're not interested, as I mentioned in my previous videos, for example, the Activision review, we're not interested in the stock price itself. We're interested in the stock variations, the jumps or the ups and downs in the stock, and also the dates where this happens. For example, if I see that on November 2021, the stock for the company I'm looking into, it dropped at 20%, for example, or 10%, what happened on that date? Not interested in the actual price, but what was the event? What drove the stock to go up or go down? And that way you can understand a little bit more about the business and the context and how it affects the company. Okay, so step number 3, competition analysis. In this step, you want to at least take a look at 2 main competitors. You will find information about competitors in tools like Tikr or Simply Wall Street. I actually like Tikr very much for this because you can go to the financial statement and, for example, plot the revenues for both companies and see how these charts compare to each other, or how the trends compare to each other, these companies compare to each other for specific criteria, like for example revenues, in a single chart. And this is quite interesting. You can do that for any metric. You can do that for revenues, you can do that for profits, you can do that for net income, you can do that for free cash flow. It is quite interesting, and you will find that in how to do that in my Tikr video. Something that is not necessary to do usually is analyze those competitors as much as you analyzed the 10K and 10Q for the company you're analyzing, because you already learned about the business and you will find similar information in the competitors. You're mostly, or at least I am mostly interested in the finances, the revenues, profits, more the financial information. Step number 4 is calculate the business value. Valuating businesses is part numbers or math. As we saw before, you analyze finances, revenues, profits, etc., and it's part also art, and this is where the art comes from. And so you normally look into, or what I do is use a discounted cash flow model. This is what I normally use, and the idea is to be, with this model, is to be conservative. You need to have some assumptions around the growth rate and also the discount rate for the return that you're expecting. So I like to be conservative with growth estimates so that you have a certain margin of safety. So for example, if your discounted cash flow worst case scenario is $60 per share, you want the stock to be well below that. I like to have a 20-30% margin of safety. And if you want to have a demo or at least see how I do the discounted cash flow, let me know in the comments and I can create a video for that. But it's quite easy, and I'll be happy to share my thoughts on that one. And finally, the last step is just to set your buy price in a price alert app and wait for a good moment to buy. Brokers, you normally be using a broker to trade your stock. So brokers usually have this feature. So you have normally a watch list, and in that watch list you can set a certain price by which, once the stock reaches that price, you will get an alert. You can do that as well with Tikr and Simply Wall Street, as I describe in my other videos. And it's just, try to find the good moment to buy once you have that margin of safety, which is, to me, is one of the most important things. So how do you find this process? Do you use a different process? Do you have more or less steps? Let me know in the comments, and thank you very much for watching.